Wouldn't it be nice if you could pay off a 30-year mortgage in less than 10 years? Yeah, it sounds too good to be true. The reality is, once you know the rules of the game, you can actually go ahead and take advantage of the game. In this video, I'm going to break down some of my tips of how you can pay down your mortgage a lot quicker as part of a debt reduction strategy. And as you go through this video, you often wonder how the starting of this video sounded a lot like a commercial for chocolate. Because wouldn't it be nice if the world was Cadbury? If you're interested, keep watching. Hey guys, my name is Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. When you watch videos as well as see these headlines about how you can pay your mortgage down in like 5 or 7 years, you really go on to thinking, yeah, sounds like a scam, but I'm gonna watch anyway. In this video, I'm gonna share with you how we do that. And if you're someone that wants free content all the time, then definitely go join my Facebook group. I'll be going in there posting more content, and the group has gone on to grow up to almost 8,000 people. So if you are interested, it's free to join. There's a link in the description below. So let's kick in to my top 5 ways of how to do this. And then I'm gonna share how you can actually do this and what the benefits would look like and how much you could potentially save. So number 1 is more frequent repayments. So if you didn't know, interest on your mortgage is calculated daily, which means effectively, if you can go in and pay more of your principal down more often, it means the interest that's getting calculated on the principal amount borrowed is a lot less, because every time you're making a payment once a month, it means it's calculating it for the entire month at that same rate. But if you happen to go and change that to fortnightly payments or even weekly payments, your actual balance reduces every week or every 2 weeks. And that interest that gets calculated on the principal amount, well, the principal keeps dropping, right? And it drops a lot quicker than every single month. This will ultimately help how much interest you have to pay over the life of the loan and can even in some cases help with your cash flow management. Number 2 is having an offset account. What the hell is an offset account? Well, I'm going to explain it to you in the most simple way. And although I had my license as a mortgage broker, I'm going to explain it to you anyway as a YouTuber. This here is your mortgage. This here is an offset account. If your mortgage has $600,000 worth of debt, but your offset account has $100,000, well, the way the bank operates and looks at this debt, the bank looks at this and says, well, you have $100,000 in your offset, which means if you really wanted to, you could pay the $100,000 into your loan. So what we're going to do is we're going to calculate this not at $600,000, but we're going to calculate it at $500,000. So basically your loan amount minus what's sitting in your offset account. Did you like that explanation? You should probably smash that like button, huh? By simply changing one thing, which is a savings account to an offset account, you start saving so much interest because every time you make a repayment, your portion is made up of interest plus principal. Now your repayments will stay the same. However, every month that you have more in your offset account, it's less interest you're paying and more of the principal. Let me say that again, although you could just rewind and replay that. For every dollar you have in the offset account, it's one less dollar you have to pay interest on that's on the mortgage. A great way to take advantage of this is to actually have your salary, all of your income, as well as your rents go into the one account, which is sitting as an offset account. Now, again, I don't have a credit license, so you can't take my word for it. You should probably speak to a mortgage broker. And this is my financial disclaimer because
I'm a YouTuber, like, come on, get over it.
Number 3 is refinancing. Now, gone are the days where 12 months ago, you could go in and say, well, I'm going to refinance every 6 months and then get a lower rate, and it keeps getting lower until it gets to a point where then suddenly we say inflation's a problem and interest rates start going back up. It's all a game at the end of the day. Now, I know, yes, there's people out there struggling, but I like to have a light-hearted approach. And although my cash flow has been smashed over the last 12 months as well, you need to understand these things are temporary. What you'd rather understand is how to learn from these things and then take advantage of the next cycle. There are always cycles, there are always opportunities. It's just about you being in the right place at the right time. So with refinancing, although you can still get loans that are cheaper in terms of interest rates, the bigger benefit here is the cashback offers. A lot of banks, what they do to encourage new customers to come across is they'll say, look, why don't you refinance with us? We'll give you a lower rate by 0.1 or 0.2%, but we'll also give you a cash bonus of maybe $2,000 all the way up to about $5,000. Now, this could significantly decrease the amount of time it takes to pay off your loan. Because imagine getting paid $4,000 and you get to refinance to another bank with a lower interest rate. The first benefit is the cash flow component is better for you, but additionally, having the $4,000 or $5,000 allows you to go and make a lump sum payment on that home loan. You could go ahead and do this as many times as you like, but again, keep in mind that it takes a lot of work, and once your portfolio grows, the paperwork alone will do your head in. Trust me, I'm going through it now. Number 4 is purchasing positive cash flow properties. How do you purchase positive cash flow property? You got to take out more debt.
Ravi, you told me not to take out debt. We're trying to reduce debt, but we keep taking out more debt. Please explain.
Have you heard the term where you need to sometimes take 2 steps backwards before you can take a step forward? Neither have I, but it sounded smart. What I'm trying to say is that sometimes taking more debt is actually going to be beneficial for you over the long run. And the reason that can play out is because when you purchase the right assets that are productive, that generate cash flow, and what I mean by positive cash flow is more income relative to the expenses. So you're paying your mortgages, your insurances, all of your property management fees, but the rent you earn is higher, means that that property that you purchase not only grows in capital growth, but it actually pays you money on a weekly basis. If you're getting paid monthly, well, then it's a monthly basis, right? Now, these are super difficult to find, and especially now because interest rates have gone up so much. But if you need help in finding property, yes, I'm going to have the shameless plug. I run a buyer's agency. That's exactly where we help clients go ahead, purchase the property. We do the negotiating. We do the sourcing of the property. You sit back, relax, and sip on pina coladas. Okay, there's a little bit more work to it, but again, if you need more information, there's a link in the description below. But if you have, say, your principal place of residence where you live has $600,000 worth of debt, and in terms of how you pay that off is through your salaries, well, imagine having 2 or 3 of these other investments that give you about $300 a week. Imagine if you had smaller investments which actually gave you about $100 a week. It means an extra $300 a week that can go towards paying your principal place of residence in terms of its debt and the home loan. This is going to significantly help this process, but in order for you to do it, you've got to buy the right assets. And that ties in with my final tip, which is extra repayments. Sounds so simple, yet not many people will do it. And during times like this, it is obviously a lot harder to go and make the extra repayments because interest rates have gone up so quickly. I totally understand this is not possible for everyone, but we're just looking at all of our options. If you are wanting to reduce your debt quickly, by paying even a little bit more, you can make a huge difference. And in a second here, I'm going to show you with the calculator and share my screen. Even an extra $50 a week will make a massive difference. Okay, so what I've got here is just an extra mortgage repayments calculator. And what we can see here is the loan amount is $600,000, the payment frequency is monthly, the interest rate here is 4.5%, and you've got a loan term of 30 years, which is pretty normal. Now, for the sake of this calculator, I've put in here $1 extra, and you're going to start that after 1 year of extra repayments. Forget about that at the moment because the calculator doesn't let me put $0. Now, in this case, what you've got is your monthly repayments will be $3,040, and this will take you 30 years to pay off. And you can see over the course of the 30 years how the balance decreases over time. Now, where it gets interesting is where we start using some of these strategies alone, and then how a combination of these strategies will really help. So let's go through this. Now, monthly repayments are $3,040, but when we change this to fortnightly, it changes to $1,402. Now, shouldn't this be half of what your monthly repayments are? Well, no, because you end up making repayments that are smaller, but you can still stick to the $3,000 a month, and that'll help reduce your debt a lot quicker. Now, in addition to this, what we can do is every fortnight, we're going to contribute more money. So let's say we were going in with a very conservative plan of paying this down, and let's put in an extra $50 a week, which would mean $100 every fortnight. Now, by just paying an extra $50 a week, we end up saving 3 years on our mortgage, and an additional $67,000 in interest is saved. Again, as I said, an extra little bit is going to make a massive difference. But if you can combine this with another strategy, being that you go out there and purchase positive cash flow properties, you do this with the right strategy in mind, and you build this over the next 5 years, you can then start seeing a big difference. So in this case, if you're generating an extra $300 a week, that means you can pay an extra $600 a week in repayments. The initial 100 plus the 600 you will generate from your investments will allow you to pay $700 extra every fortnight. And just like that, you were then saving 14 years of the entire loan, and you save almost $250,000. This is actually crazy when you think about it in real terms. To be able to save that much money is insane. But again, the process of understanding this is easy. To actually execute is very difficult. And that's why you might just need the right team around you, the right brokers, the right accountants, possibly a buyer's agent, unless you want to do it yourself. Now, you can definitely go ahead and play out how this could look like if you had 5 investment properties. In this case, we've done this based on 3 investment properties and in the right locations. What you haven't even factored in is that once interest rates start cutting and your rents continue to go up, because we do have a rental crisis, and I do cover this in this video, so definitely go check it out, is that when a combination of these things work out for you, you are going to be able to pay off this loan in less than 10 years. The main point I want you to take away from this video is that if you are in the mindset to pay down debt, well, here are some strategies that you could use to pay down that debt quicker. For me personally, I'm not paying down my debt, I'm taking on more debt, but I'm not a financial advisor, and I think for you, you need to figure out what your strategy is long term. If you're just simply going, well, I can pay down my debt today, in 5 years time from now, you're gonna often wonder, was this a generational opportunity for me to build wealth or to reduce my debt? And that's something I'm gonna leave you with. If you guys have enjoyed this video, smash that like button. It gets pretty hot in here. but I'll catch you guys in the next one. Thanks, guys.